You're going to jump right into, oh, you're good. We're here.
Hey, what's going on? Anybody watching this live? This is Brian Williams of Northshire Consulting, and I'll let Jake introduce himself in a couple seconds here. But this is Fiduciary Friday. So what we do is we pick a retirement plan that's out there. We go through some of the plan specs. We talk about some of the plan design options that are out there, and we take a look at the investments. So I'm joined by Jake today. We didn't do a whole lot of prep work intentionally because we want to kind of go through this together, and I'm curious to see if the things that jumped off the page at me are the same that jumped off the page to him. So what's happening, Jake?
Hey, Brian, excited to be here. You know, this is fun stuff. We obviously love 401ks, and this is our life. So, I mean, there's not a time where I'm not excited to look up a plan and dig into it. It's just kind of something that I find appealing because it impacts so many people. And this is a huge plan we're going to look at today that I think definitely should be a leader as far as what they're doing, but we're going to find out. We're going to dig into it. So I'm excited to talk to you about it.
Absolutely. Yeah. I mean, there's certain things that if, I could wave a magic wand, they would probably change. And it's funny to, it's fun for me, especially dealing in the plan size that I deal with and the plan size that you deal with. We probably don't get into what we consider like a mega plan like this very often. So it's always fun to sort of sink our teeth into this, but, being a financial services company and being at the forefront of some of the things they're doing on the ESG side and, everything that they want to do for employees, it'll be fun to take a look at it.
Absolutely. So that's the thing. No matter the size of plan, what I found is they're all the same structure, right? It doesn't, even if it's a billion, massive plan and we got to start a plan, this plan document literally could be the same thing, right? But there's a lot of different things that go into the plan document. But there's not a difference in the actual tax code to make this happen. So
that's a really good point. I mean, when I started and when you started, I mean, there were certain advantages that bigger plans could have access to different things and different plan design features, and then small startup plans and whatever. So that's stuck in these crap annuity products and just loaded with fees and less transparency. But now we're in an environment where literally all the same funds that are available to BlackRock employees could be at the 4-person bakery. You can get the same exact investments, which is a really exciting development over the last, 10 years or so.
Yeah, exactly. There's been so many improvements that have only enhanced the experience, but also lowered the cost. I mean, technology is just making our lives better. So I think we'll continue to see that happen.
Absolutely. So this is a plan. A member of the group had reached out to me and asked us to take a look at it. So, with these mega plans, there's always a lot of information that's available. Sometimes you'll just see third-party sites that rate these plans, and obviously the IRS Form 5500 and the audit reports are available. But this person in our Facebook group had sent me some of their enrollment materials and stuff. So that gives us a little bit more color and really just kind of lets us look at how the look and feel of the enrollment materials too, which is kind of neat. So I could pull some of them up here.
Yeah, that's what I found pretty fascinating. These big ones, there's a lot of times the different goals in mind. When I look at a 401k, there's two objectives that you have to have. It's tax savings and it's retain, recruit talent. And so their plan, BlackRock, there's a few things that popped out, like the after-tax option, and there's other things like that where you just don't see in smaller markets. It's just not common. But those that don't know, I mean, BlackRock is a massive financial company. They do a ton of work in the investment space. ETFs, mutual funds, all those things. So we see them in a lot of different areas, but to look at their actual plan is I think always fascinating. So they do have, like you're pulling up right there, the key features, automatic enrollment. I mean, that's a huge push in the large market space, which I don't think it actually said how high if it does auto enroll and auto increase up to 15%.
Up to 15%.
So they're really trying to make the push to get people to contribute, and if they do not do anything, it happens anyway.
Right, and we talk about this, how it translates into the smaller plans. The 5-person bakery or whatever down the street. You can do automatic enrollment, and it's easier, I think, on plans of that size because you have everybody in the room, and you can give them the ability to opt out. If for whatever reason a participant didn't want to, an employee didn't want to participate, and there's tax credits available. So for those who haven't started plans yet, you get an extra $500 to add automatic enrollment. So why would you not do it? But it's great to see that BlackRock has this in place already. And at 8%, that's one of the higher initial rates I've seen. How about you, Jake?
Yeah, it's got a great match. I mean, that's when you see the competitive nature that they're in as far as keeping talent. They have to do that probably because their peers, the other groups that their talent is looking for and looking at are at that
Mhm.
high level. So, I work for a large investment bank, and that's where you get some of the largest matching or other contributions, profit sharing. Just that's how it happens. So,
Yeah.
but it was
So I,
fascinating. They only allow you to put up to half of your pay in, which I found that interesting. I mean, why would they limit that? Because most plans I work with are the whole thing if you wanted to. Not
yeah,
that
I
everyone
thought that was
does
a
that,
little
but
strange. I mean, there's probably not a lot of super low income people at half your pay, you're still, if you're making 40,000 and you put away half, you're right around the limit anyway. So there's probably, I would guess most of their employees are probably full time and probably over that limit. But yeah, it is kind of weird that they cap it there.
yeah. Yeah. And
Um,
then, I mean, once they've got their money in there, they're auto enroll, they're auto escalating, and they get this match. The thing that caught my attention the most, obviously, was that all they have are BlackRock funds, right? Did that
right.
surprise you too?
Yeah, it did. Yeah. And the matching contribution capped at $5,000 a year was kind of interesting too. It's another one of those weird things you don't see that capped at 50% for the employee contributions, and you don't see a lot of capped matches like that. But then they give this boost down here too, after you've been with the company for a year too. So it is fairly generous, no doubt about that.
Yeah, but I do see those interesting structures that you don't see in smaller plans because compliance would just be a disaster. But when you have, I didn't even look how many employees do they have? Did we see that anywhere?
Yeah.
You got that pulled up?
After, yeah.
So there are
So
11,000 people
yep.
in the plan. Active plan account holders in there. So that kind of scale can really make testing a much easier process.
Yeah.
But can you imagine the behind the scenes work by the TPA to run run
I
testing and
know.
gather that data?
Yeah,
Quite a
yeah, they
bit.
better have really good payroll integration and all that sort of stuff
Yeah,
too. So, yeah, I
360
guess
is
we
a
should,
definite must there.
right. Yeah, I guess we should mention it's run by Merrill Lynch. They mentioned a few times, benefits.merrilllynch.com is where you find the information. And the enrollment materials are really straightforward, I thought. Things are spelled out. I like this section in here where they talk about rollovers. They're not thirsty saying you got to roll money into this plan or whatever. They go through the options where from a previous employer, you can roll money in, go to an IRA, convert it. They sort of walk through those things. So I like the way they did that.
Yeah, I agree. Like the more transparent they can be and help people understand in real plain language, the better. Because if you hand out a summary plan doc that is straight legal jargon, I mean, people just don't know. So
Yeah.
when I see them start to try to simplify it, I think it's really valuable.
Yeah. Beneficiaries, you can change those online, which is great. Most service providers have that. You have a couple loans that are up to 2 loans is available. I think that's kind of the sweet spot. I mean, offering one loan, I mean, sometimes people want to do the refinancing thing. So you want to, sometimes have the 2 loans. Anything more than that just gets to be an administrative nightmare. So I see 2 as kind of the sweet spot. It's almost either no loans at all or 2, I think, is sometimes the way to go.
Yeah, I would agree.
So they do a pretty good job here. They talk about the target date funds. They talk about access to advice. And the target date funds are the life path funds, which spoiler alert are BlackRock funds, as Jake mentioned before. I guess we should probably talk about that too, because even though it seems like a natural fit, there's been a ton of lawsuits over the last year of kind of the self-dealing and the self-promotion of the company putting their own funds in there. I look at this and say, if I was running this plan, I would just use another target date suite. It's just not worth the hassle, or you can almost predict that at some point, if they haven't already, they're going to be a target of some sort of suit here.
And I think they're probably hanging their hat on the fact that these are low cost and hoping that holds up and that will help them. But they better have a process of why they pick these and how they benchmarked, and design their lineup. Because to say that BlackRock's the best at everything is a very bold statement, even if you just say, well, we're the cheapest. I know that's not going to hold up. And so it's all about process again, right? We're not trying to predict the future and have the best performing funds. We're just trying to have a process that gives everybody in the company a fair shot. All 11,600 people in there have to have something they can pick from that they feel comfortable with. And how did you come to that decision? That's the battle.
And as you would expect, they're all going to be, very low price share classes. I mean, they do have the one American Funds, Euro Pacific Fund R6. That's the least expensive share class. And then they do have a couple non-BlackRock funds.
That's weird, right? There's like 3 of them. There's 3 that aren't BlackRock. Yeah. I just want to know how that happened. Like, what was that meeting like? Well, we better mix in a couple more. It just seems odd.
Yeah, it does seem odd. Yeah. And they have the self-directed brokerage account service too, which a lot of the bigger plans have. I wonder too if there's any restrictions on that, whether it's, you can only invest in mutual funds or only invest in ETFs, because sometimes those self-directed features, people can run into some trouble on those if they get involved in meme stocks and things like that.
Yeah, some will even limit how much of your whole account you can put in. Mm-hmm. And I've run across plans even recently that have had limits put on who could put money in self-directed, which is totally out of compliance. So I would never, even on a mega plan, you think everything's gonna be buttoned up tight. I would never put it aside them. Like, there's probably a way that everyone can do self-directed, but there's a lot of disclosures involved with that. And sometimes most of those connections are TD Ameritrade and Schwab, which are basically one and the same now. But even in that setting, it's still important. I think people understand what they're getting into.
I think so.
Moving their money there.
And for smaller plans, I think it's, it's probably not something they should really be involved in. I mean, you deal a lot with doctors, and I know professionals sometimes feel that they want to, do their own thing, or they're smarter than the average bear, right? They know the hot stock or whatever and want to go there, but it can be a compliance problem for sure.
Yeah. I mean, what's fascinating is that the bulk of the largest holding is the Russell 1000 fund, right? Mm-hmm. That's not a default fund. So my guess looking at this is there's a managed account situation, that this 401k has a managed account platform that people can opt into, or maybe that's something to do with, I don't know, we have to dig deeper, but that to me makes me think that the target dates are not the default. Right.
Yeah, that's a good point. Target dates do have a lot, or maybe they weren't originally the default or something.
Yeah, it could have changed. It could have changed over time. Managed accounts are gaining momentum. And those that are watching that don't know what that means, I mean, managed account just is another level as far as customization of to what allocation you get based on a lot of factors, not just your age, right? Target dates, that's all we know. It's your birthday. We got to do something with your money, but we don't know much about you. But where you get involved with managed accounts, there is a really great, it's a great tool. It's just a matter of, is the cost justified in what they provide? And I've seen good managed accounts and others that are not so good. And one way I heard it explained to me the other day, I thought was really useful, is that they are using more data, like if you're married or not, if you are, what your salary is. So even things that you don't even have to answer in a question, they already kind of can know from data that the company provides in the census data to help allocate you to the right account type. But understanding somebody's risk tolerance is one that's never going to be a perfect way to, you can't answer that very effectively every single time.
No, and there comes a time for us as the advisor where it's like the risk tolerance. Yeah, that's important. But if you run a risk tolerance questionnaire for a 22-year-old and it says they should be 100% in the guaranteed account, well, you almost have to encourage them to sort of override what their risk profile says and educate them, because you have a fiduciary responsibility, not just to do what they tell you, but to put them on the right path. You can't have them stuck in an account that's earning 2% for the next 40 years. So you have to sort of coach them through that. So it is a balancing act there.
Yeah. And look, there's 29 million in the self-directed. That's a huge chunk of money, but relative to the size of this, $2 trillion, $2.6 billion plan, that's pretty small, right?
It is.
That's surprising. You would think there'd be a higher balance over there, but that tells me there's a lot of people there that believe in the BlackRock funds. The couple funds that aren't BlackRock, I guess there's they've got PNC stock. There's American Funds has a good chunk of money. So, and the ones that are not BlackRock are not in CITs, which I don't think we have to get into, but CITs are definitely, you're going to see more of those, and they're just similar, but a little bit less transparent is what bothers me.
Right. I know you save a few basis points, but you give up some of the transparency. And doing employee meetings over the years, one of the fun things to say is, hey, you've got a 5-letter ticker. You could put this into Morningstar and look it up and see actually what you own and kind of tell that story as an educator. But you can't. It's not as easy to do with a collective trust, unfortunately. So you do miss out a little bit on that education piece.
Scroll down to the loans. How much do they have in loans? 16 million. Okay.
Yeah.
That's not bad. I mean, for 11,000 people, it's a lot of money
Right.
out there, but that most of these people work in finance and have a good understanding of money. So that kind of speaks to that.
Right. Yeah. And looking at this here almost makes me think that there are some limitations on the self-directed brokerage account. So maybe you can only invest in a certain set of ETF lineups or something that they approved, or, they may not let you invest in individual stocks, or maybe there's certain leveraged ETFs or mutual funds that they may restrict there. I don't know, but
true. What can you scroll back up to the fees, like the fees section of the 500? Do you have that readily available?
Sure.
I'm curious how transparent it is. A lot of times these 5500s aren't as clear as we'd like. So like you said, Merrill Lynch is on there. Here's what's fascinating. It shows $9,000, which that should be the actual number. That's crazy low.
Right.
Which is why they marked yes on indirect. So there's no way they're doing that for $9,000. So that's what's frustrating about these 5500s. What's real and what's accurate? It's hard to say.
Right. And you wonder where that indirect compensation comes from, because there's nothing on the fund side that would indicate that there's any sort of revenue sharing agreements or anything like that.
Does in the audit balance sheet, does that show? Right. So those of you watching, so whenever a plan's over 120 people, that's obviously way over that, you have to do this audit. And so you can see in the audit a lot more details as far as what the 5500 would maybe show. So this doesn't even show. It's not even listing out the admin expense. Interesting. Okay. Well.
Yeah, you would hope that BlackRock is paying for them directly and not taking them but taking the fees from participants' accounts. But you never know.
Yeah, I mean, but you factor in what would be a competitive rate if you were benchmarking a $2.6 billion plan, and that's where you get to this mega plan size where you would think the fiduciary should be negotiating fees that are fixed and definitely not based on assets, because even 1 basis point of 2.6 billion is a ginormous amount of money.
Right. I know. And this is interesting here. So it says you'll be charged a fee if you enroll in the personal manager feature of advice access. So a lot of these, sort of managed accounts, or there's an additional service sometimes provided that gives another level of planning. And here it looks like it's optional. So you probably go online and adopt into some sort of either automated feature, or there might be somebody who, you do something remotely and work with online. So that looks like an optional feature that's available, but it doesn't give much detail as to what the actual fee is for that service.
Yeah, that's definitely the managed account setup. But what's that cost?
Yep. And you've got you do have company stock in here, which we talked about before, and not a ton in there. I mean, nothing that's alarming. Sometimes you see that as the number one holding on some of these plans, which is a little bit scary. But you're not seeing that as much as you used to. And you used to see sometimes where the match would be all company stock, where they'd give you a match, but it was in company stock. And you don't see that as much anymore either.
Yeah.
So here you have the plan sponsor and service agreement have agreed upon $51 per participant to cover administrative services.
Interesting. So that, if they're doing $51, that's really competitive if that's the only admin cost. But this kind of plan is definitely going to be bundled. It's not something that you're going to have a TBA working on. But what would that equate to? That's with 11,000 people, that's almost 600 grand.
Yeah. Yeah.
So when you take that, and what's 600 grand of the total assets, you're talking 2 basis points.
Yeah.
So,
yeah.
At some point, people have to get paid for the work that's being put into the plan, but there's definitely scalability and commoditization of what a record keeper does. So I don't know that it's just a different from what we normally work with, the size and scale plans we work with. It's hard to really gauge what would be a dollar amount that would be, in our feeling, a good one that isn't excessive.
Right. And we do know that when you add in self-directed brokerage account and when you have company stock, when you add additional layers of complexity, somebody's got to do all that record keeping. And it does have down here in bold that it's BlackRock's current practice to pay the $51 on the participant's behalf. So it looks like that might be something that can change from time to time, or they have the leeway to push that back to participants if they need to. But so that's always good to see. We talked about that before. Anytime the employer can pick up the fees for participant, that's a good thing.
Yeah, absolutely. Which I think is definitely common in a financial industry, because they're going to pick up all the admin fees they can, so that the participants are basically just paying for the funds they select. Yeah. I see that a lot more often.
Yeah, and on the self-directed side, as you'd expect, there's no. Most trading now is low to no cost anyway. So like Jake said, if you're using Schwab or TD, those are free anyway. If you're going to make a call and you need to talk to somebody, there's a cost for that. But most people are working through that online. So that's about what you'd expect. Yeah,
I would say overall, this is a pretty button-up plan, other than the fact that it's 95% BlackRock funds. That to me, that's the red flag that would pop out. But
yeah,
if they have a process behind it, that'd be good.
Right, and when you're looking at the fee disclosure, they're collective trusts, and they're all actually at 1 basis point. So for people not familiar with basis points, that's 0.01%. So if you've got $1,000 invested, the cost to be in that BlackRock fund is 10 cents. So that's going to be pretty tough to beat. But yeah, it is. There have been some issues with other service providers. I know Fidelity and Hancock. They've all had issues with their employees suing because they were using their own funds in there. So it is something to keep an eye on, but doesn't necessarily mean it's wrong or that it's a major compliance problem, but just something to watch.
Yeah, and on Brightscope, I know they had 86 out of 100, so they're hitting on all the different positives of their plan. They've got high enrollments. People are contributing. The match is great. The fees are low. Overall, they've done a lot of good things there.
Yeah, and so people who haven't used Brightscope before, it's one of these services that pokes into basically did what Jake and I do, but they have an automated process to work through that, and they score all these plans 1 to 100. So 86 is actually a pretty good score. That's one of the higher I've seen. Very rarely do you see anything in the 90s. So it's going to be tough to beat this plan when you got the company paying all the administrative fees and your investment expenses are as low as 0 or 0.01%. It's going to be tough to beat.
Yeah, and one other place I love to look just to kind of get a better listen to the actual participants, and bigger companies it's easier to do is on Glassdoor, and they actually have a score of 4.1 stars out of 5 from 39 ratings. So it's not a huge sample, but most of the people are just pretty happy about the match. So it's a pretty generous match. It's always good to see what kind of, I think, comments or reviews people are giving, because it tells you a little more about how is this being communicated, which is a huge value in what a 401k can bring. Is if no one understands it, then it's not going to be valued. If they understand it, they use it, it's working for them, that means they understand. That means communication is working. Someone's telling them what's going on. And when you have 11,000 people, that's not an easy task. So something's going right here for people to know about it.
Right. Yep. Yeah. The match is good. And I forgot if we mentioned vesting or not, but 100% vested after 3 years of service. So, and obviously anything the employee puts in is always vested, but in any plan. But yeah, that is generous. And, sometimes you see vesting schedules up to six years long or so. So anything less than that's pretty good.
Yeah. Yeah. Overall, I mean, I like it. I think it's a great plan.
That's good. Yeah. What's your normal scoring method? You go what, 1 to 10, no sevens?
That's right. Everyone, you can always stay safe with a 7. So it's no 7s. This one, even with the BlackRock, if BlackRock wasn't a low cost index solution, I would have more problem with it with all those funds. So I give it an 8. But my reviews don't mean anything. It's just my opinion. So, because I think there could be some improvements to the fund lineup. That being said, I bet when you benchmark these funds versus a Vanguard or Fidelity or any other index, fund family, it's going to be so close because it's an index.
Yeah, right.
How much more can you squeak out of it? It comes back to that. They allow after tax. They allow mega backdoor Roths, basically, stuff like that is just not. It's hard to forget those things and just focus on fun.
Yeah, you got to have those for plan this size. At this point, you got to have all those. Yeah, the only thing keeping it down a little bit is the sort of the weird caps they have on your own contribution and the cap on the matching, and like you said, the proprietary funds in there. It'd be neat to have them. Maybe have a multi-manager type approach to some sort of, managed account solution. They had some different funds in there. It'd be an interesting way to see them look at that. And I don't really see ESG involved too much in there for all their talk about that. They do have their Global Sustainable Equity Fund, and let's see what else here. I don't know if in the life path, because they're CITs, maybe they have some ESG component inside there, but it's certainly not a huge requirement or anything like that. Yeah.
Yeah, you can definitely see that.
All right. So that's good. Well, that's just about half an hour. I appreciate your time. I'm Brian Williams from Northshire Consulting. So if you're not watching this live, you're watching it on YouTube. So we encourage you to check out our Facebook group, 401k and Beyond. And then I'll let Jake close out with his info.
Like, Brian, I want to say, we have people here listening, the group is awesome. There's a lot of good people in there, and I've seen some great questions coming through, and that's what this is all about. The 401k world is so vast, and there's so many nuances to it. And so surround yourself with people, whether that's a big deal for you now or later. There's going to be times you have questions, and there's not a better group of people out there that you've pulled together so quickly. So
awesome.
Thanks for having me on. Thanks for being having me be a part
absolutely.
of it. It's fun. We should do more of these.
All right. Thanks. Enjoy your weekend.